Ever feel like you're just throwing darts at a board with your investments? Well, today we're going to change that. We're going to build your essential investors toolkit with 5 key metrics that are going to help you analyze companies like a total pro.
I mean, that's really the big question, isn't it? How do you stop guessing? Stop just following the latest hype and start making really smart, confident decisions with your money. It's all about having the right tools.
And that's exactly what we're doing right now. In the next few minutes, we're going to arm you with 5 super powerful financial metrics. These will help you look at any company and actually understand what you're seeing. All right, you ready? Let's get into it.
Okay, first things first, let's talk about the price. You see a stock price, but how in the world do you know if it's a fair price, a good deal, or way too expensive? Well, our first 2 tools are designed to answer exactly that. So let's meet your first tool. It's the price to earnings ratio, or as you'll always hear it, the PE ratio. Honestly, the best way to think of this is like a basic price tag checker. It tells you how much investors like you and me are willing to pay for every single dollar the company makes. And the math here is super simple. You don't need to be a genius. You just take the current stock price and divide it by the company's earnings per share. So let's say a stock is $100 a share, and it earns $5 per share. That gives you a PE ratio of 20. Simple, right? It just means you're paying $20 for every $1 of profit that company is making right now.
So why do we even care about this? Well, the PE ratio is your first big clue. It helps you get a gut check on whether a stock might be overvalued or maybe undervalued. A really high PE usually means people are expecting huge growth down the line. But, and this is absolutely crucial, it's pretty much useless unless you're comparing companies in the same industry. Trying to compare a car company's PE to a software company's, that's just apples and oranges. It doesn't work.
Okay, but here's the catch. What about those super fast-growing tech companies? They almost always have a sky-high PE ratio. Does that mean they're a bad investment? No, not at all. The PE is just a snapshot in time. It doesn't tell you anything about the future. For that, we need to pull another tool out of the box.
And that tool is the PEG ratio. This thing is pretty slick. It takes the PE ratio we just talked about and adds in that one missing piece of the puzzle, growth. It literally factors in the company's expected earnings growth rate, which gives you a much clearer picture.
Now, if you remember one thing about the PEG ratio, make it this, the rule of 1. Generally speaking, if you find a PEG ratio that's hovering around 1 or even below it, you might be looking at a stock that's fairly priced or maybe even a bargain, considering how fast it's expected to grow. It's a great little shortcut. So, let's put these 2 side by side. The PE ratio, that's your snapshot of right now. The PEG ratio, that's the picture adjusted for the future. You see, PE on its own can make a great growth stock look ridiculously expensive, but the PEG ratio adds the context you need. Using them together, that's how you get a much smarter perspective on price. All right, so we've figured out how to gauge the price. Now it's time to pop the hood and check the company's engine. We need to know, is this thing powerful? Is it efficient? Our next 2 tools are going to tell us just that. Tool number 3 is earnings per share, or EPS. Look, if a company was a car, EPS is basically its horsepower. It's a straight-up measure of how profitable a company is, breaking it down to show you exactly how much profit belongs to every single share of stock. And what you're looking for here is a trend. You want to see a history of that EPS number consistently going up year after year. That's one of the best signs of a really healthy growing company. On the other hand, if you see that number suddenly take a nosedive, that is a huge red flag that the engine might be having some serious problems. So, sticking with our engine check, let's look at tool number 4, return on equity, or ROE. Okay, if EPS is the horsepower, then ROE is the fuel efficiency. This metric is all about how good the management team is at using shareholders' money to make even more money. And what you want to see is a high and stable ROE. We're talking something in the 15 to 20% range, or even higher. That is a fantastic sign. It tells you the people running the show are really good at turning $1 into more dollars. And that means the company can grow using its own profits instead of having to borrow a bunch of money. Now, that's what I call a well-oiled machine. Okay, we've checked the price. We've checked the engine. There is one last absolutely critical step before we hit the road, the safety inspection. We have to know how much financial risk this company is taking on. And our 5th and final tool for that is the debt-to-equity ratio, or DE. You can just think of this as your safety meter. It puts the company's total debt side by side with the money that its owners, the shareholders, have put in.
It's a direct look at financial risk.
And just look at this. It makes it super clear. Company A is on solid ground, right? It's funded mostly by its owners. But look at Company B. It's relying heavily on borrowed money. Now, if the economy hits a rough patch, which one of these companies do you think is going to be in deep trouble first?
Yeah, a high DE ratio can sometimes boost returns when things are good, but boy does it increase risk when things go bad. A low ratio suggests the company is much more stable, but just like the PE ratio, context is everything here. Some industries, like utilities, just naturally have more debt, so you always want to compare a company's DE ratio to its direct competitors to get the real story. And there you have it. Just like that, you've put together a brand new, powerful investing toolkit. 5 simple but incredibly effective metrics to help you analyze a company from every important angle. So let's run through them one last time. You got the PE ratio to check the price tag, the PEG ratio to see if that price is fair for the growth. You got EPS to measure the horsepower, the profitability, ROE to judge the fuel efficiency, how well management uses money, and finally, the DE ratio to do your safety check. Altogether, they give you a complete inspection. You know, this quote from our source material really just nails it. The whole point of this is to stop guessing. It's to do a careful analysis using the right tools so you can actually understand a company's health, its value, and where it might be going. So, from now on, when you look at a stock, you're not just going to see a ticker symbol and a price. You now have the toolkit to pop the hood, check the engine, and really see what's going on. So the only question left is, now that you have the tools, what story are the numbers going to tell you?